video, I'm going to tell you about macroeconomic policy, and this includes two main different policies. First is fiscal policy, and the second is monetary policy. So let's start with fiscal policy. So it is role of government, and they try to manage their taxes and spendings, and the main goal of that is to stabilize economy and to ensure growth in the country. So they can change that, and of course they may try to increase taxes, but of course that could slow down economy, because it is discouraging business by reducing the profits. And of course there is a second side, which is much more positive, because higher taxes gather much more money for that things like education, healthcare, infrastructure, like roads. So that's the main problem of fiscal policy. So, and these things actually are very positive for economic growth. So governments need to decide how high taxes should be, and very often governments spend much more than else, and that create national debt. So it's very problematic, and reducing it is difficult and politically unpopular. So from practice, if we look at what happens now in Greece, they cannot have very strong problems with reducing their debts, and other situation is Hungary, when they trying to reduce their debts by increasing taxes, but of course it is very unpopular, and many people criticize government of Viktor Orban by taxes like taxes on the internet, for example. So it is very problematic and difficult, but of course governments need to balance between higher taxes and debts, reducing their. So second side is monetary policy, and it is done by central banks of countries. So most banks are focusing on the inflation target. So look at, for example, Polish central bank is trying to reduce national debt to around national inflation around 2%. So they try to control money supply to change consumer demand and consumer credit demand, and main tools how they do that are interest rates, reserve requirements, and open market operations. So interest rates, it is a base rate, discount rate, which is managed by central bank, and this is interest paid by commercial banks, which are borrowing from central banks. So this is we can say the value of money, and commercial banks passing that interest rates on business or consumer credits. So the change of interest discount base rate affecting all interest rates in financial systems, and that also affects the demand for credits and consumption. So higher interest rates reducing demand for credit and reducing spendings, and that make inflation lower. Analogically with lower interest rates. Second thing is reserve requirements, and this is a percentage of all deposits which commercial bank should have to store as a cash. So higher level of this reserve requirements makes that is less money for loans and credits. So also a higher level cooling economy. And third thing, the third type of monetary policy is open market operations, and it is buying and selling government bonds by central bank. So if central bank wants to cool down economy, they selling bonds and reducing the amount of money in circulation. So level of credits and consumer spending are lower, and by increasing money, solve this situation when government trying to buying government bonds is stimulating economy. And today I found information that interest rates in Poland are 1% and 1.50. This base rate in Poland, and as you see, it was lowering since 2012 from around 4.5. And the second thing is inflation in Poland. So as you see, the inflation in Poland had dropped very strongly. There nowadays is negative level below even 1%, and that's the main factor why the government central bank decrease the interest rates, and of course they make some prognosis for the future how inflation will be, and they said that till the end of 2015 it will be below their target. Probably in 2016 it will be go to around their goals. So that's all about macroeconomic policy. Thank you for listening.